Hello everyone and welcome to another Wyckoff series video. And this, I think, is the 10th video. And so I think, maybe celebrations are in order. If you've watched this far, maybe you watch the rest of the videos coming up. Okay, we have learned about a lot of stuff, how markets move, the Wyckoff method, fundamental laws, accumulation, distribution. And then in the past two classes, we talked about the preliminary stop and the climax. Okay, and what we're going to talk about today is the third event in the Wyckoff methodology, which is the reaction. Okay, and the reaction is a very important event because it delimitates the actual happening of an accumulation or distribution. Okay, and after you have a reaction and a secondary test, then you can affirm with more certainty whether we are in an accumulation or distribution, and then you can fine-tune what your thinking process is through time. Okay, so what the reaction is basically, as we talked about in last class, you have a selling climax, right? You have a point, for example, in accumulation, where everyone is selling, right? And what happens is, for example, if we look back here, you have this point here as the selling climax, right? A lot of people were selling and Bitcoin was down, 14% in a day. And if you count the wicks, we went down almost 30% in a single day. Okay, and what you see after that, especially if we go to lower time frames, which this chart that I'm watching right now, the BLX, doesn't support, is a big rally in a short amount of time. Okay, so what we can see here, for example, is that in just a couple days, if you count the wicks, we went up almost 40%. Okay, almost 40% in just a couple days. And in the previous market conditions, we were used to, if we count the wicks, maybe 11% in a day. Okay, so this represents a major change in character of a trend. This represents the stopping of a downtrend in the case of an accumulation and the stop of an uptrend in the case of distribution. Okay, so we can look at the distribution example here that we had back at the start of 2021. So usually when we were going up, we usually saw, these minor corrections. So from here to here, we have like 8%, maybe, I don't know, from here to here, we have a minor correction, maybe 10%, right? And then suddenly, in just, 4 or 5 days, we go down 26%. And this represents a major change in character of a trend, So this has great implications, as Ruben points to us here, and it just puts an end. It puts a definitive end to a previous trend, okay? And it starts this environment of lateralization, okay? So it might not be, if it is a downtrend, it might not necessarily be an accumulation, okay? It can be a redistribution, but it changes the character of the trend from going purely down to maybe going sideways for a while, okay? Consolidating and accumulating or distributing, all right? So it has a few implications, and we talked about this. So if we are used to smaller corrections and suddenly it moves in the opposite way of the trend in a way bigger fashion, right? As we had here, for example, right? And as we had here, for example, then you can call that an automatic rally, okay? Or an automatic reaction, okay? And it has a few characteristics of its anatomy, okay? So first, in Wyckoff theory, in general, the automatic rally, it serves to basically start the distribution range that we have. Now, of course, it's not always going to be perfect. Okay, so this first automatic rally or automatic reaction, it usually serves as the top of the range, and sometimes we can go above it a little bit. For example, here, right, we go above it by a tiny bit, but it doesn't last long. Okay, and if you would consider the range, and we'll talk about the secondary test later, this would be mostly the range. the automatic rally and or the automatic reaction and the secondary test here. Okay, and this is, as you can see, basically a perfect range, right? And same thing for the accumulation here. So you have an automatic rally here, right? And then you have some secondary tests to the downside, and you would say that this is mostly the range where price was constrained to. All right. Okay. Now it has a few uses, right? As I talked about, it has, the upper limit or the lower limit if you're talking about accumulations or distribution. And to identify it, it basically identifies the genuine, like when you see a climax and it actually is a climax and not just a preliminary stop that we talked about before, it has necessarily an automatic rally or automatic reaction. Okay, and it provides us the market context. Now, Ruben points to us here, how many events should you count? I specifically don't think that this is particularly useful, okay? Trying to count the events and measure the lengths to project it into the future, especially because what Wyckoff did and what Ruben points as methodology here is mostly fine-tuned to the stock market, right? And so crypto might behave a little bit differently, even though the basic principles are the same because the market psychology doesn't change. Okay. Now Ruben also talks about just downgrading the chart resolution, for example. I also don't like that much. I don't like this that much, and I don't like looking like below the 1 day chart. Maybe sometimes I'll look at the 4 hour chart. All right, because I have a past with being addicted to charts. Okay, I am in university and I basically almost failed many classes because of it. And so I don't like watching below it. And I think that all the information that charts below the daily provide us is really not that great. And it's not that good to just make assertive and confident predictions to the future. Okay. Now, of course, we have the two different patterns that it can show. So first, in an accumulation structure, the automatic rally, as we call it, will delimitate the top of the range, and the secondary test will delimitate the bottom, right? And why does it take place? Okay, and this is the main point of the Wyckoff theory, trying to understand why things happen the way they do. So first, we have the conditions of exhaustion of the offer. Okay, so many aggressive sellers, they stop entering the market. A lot of these guys that are selling on market, they at market price, they stop selling, right? And this is after we have that selling climax, that capitulation. A lot of people are covering their shorts, right? A lot of people are, just closing their shorts and basically diminishing the downward pressure. And finally, new buyers enter once they observe this climactic, reaction. So if you see Bitcoin going up 40% in a day, maybe if you were a naive investor, you would start going in because you think this might be a V-shaped recovery or whatever. Okay. And the most normal thing, as I said, is that they do not intend maintaining it to the long term unless they are, really, really naive investors, right? But they try to trade during that time. And once you see, things changing a little bit, maybe you could even watch the long short ratio charts and volume distribution charts. But that goes a little bit in the Wyckoff 2.0 course that we'll have exclusively in the Crypto Garden. Now, in the context of a distribution, we have the automatic reaction. Okay, and the automatic reaction is basically the same, but flipped upside down. Okay, so it delimitates, instead of the top of the range, it delimitates the bottom of the range, right? And instead of the secondary test delimitating the bottom of the range, it delimitates the top of the range, and so on and so forth. Okay, and this is a pretty great diagram here. Okay, and again, inversely to the automatic rally, what we have here is first the exhaustion of demand. So there are no aggressive buyers willing to keep buying. So you see a diminution, like the market buys start becoming lower. So less and less people are willing to buy at market price, right? Second, we have length coverage. So the large longs are being closed, right? And finally, we have appearance of the after. So a lot of people, they start selling, especially once they see this previous climactic event. So they start selling once they see Bitcoin going down like 25% in a day. And this, huge distribution structure, for example, is made specifically to trap people, right? It's not because you sold here that you're going to be out of the market. No, you're going to be always, wishing for new opportunities to buy. And then what the market, the Wyckoff method, the Wyckoff theory proposes is that these, large buyers, they are trying to manipulate you to, during this range, you sell here and you buy here, and you sell here and you buy here, and they start buying all of the supply available, and they leave you holding the bag so that they can sell as much as possible for the highest price possible and buy as much as possible for the lowest price possible. Okay. And okay, so yeah, these events, they are a little bit dense. So I think you guys can watch the charts, try to look for examples, and try to apply the theory as a little bit of a homework. Next class, we'll talk a little bit about the test events, the secondary tests and the generic tests. And I think this will be a really important class. Okay. This is basically the end of what we call the phase A of the Wyckoff accumulation or distribution. And so it can be a very valuable thing to identify accumulations and distributions. All right. So if you want more exclusive content, including, newsletters, spreadsheets, and more videos, you can join the Crypto Garden at the cryptogarden.io. And I think that's enough for a video. So goodbye.